Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, December 11th. We are busy preparing the 2025 market outlook for you people. So I take the opportunity to dive into one question that is often asked to me, the Fibonacci retracement. What is it and how do I use it? So let's dive in. So as I said, today we are filming the Market Outlook 2025. So I won't be able to prepare my regular market talk video, but I decided instead to dive into one of popularly used and one of my favorite technical indicators out there, which is the Fibonacci retracement. So those of you who actually follow the market talk episodes quite regularly are familiar with the concept because I use very often the Fibonacci retracement in my daily analysis to determine key support and resistance levels, the levels that might eventually trigger a bullish or a bearish reversal in market prices and that are quite interesting to watch for traders who are trying to make a meaning out of the numbers that they see on their screen on these trading charts. So to understand the Fibonacci retracement, you should first understand the Fibonacci sequence. That goes like this: 0, 1, 1, 2, 3, 5, 8, etc. So each number here is the sum of the previous two numbers. 0 and 1 equals 1, 1 and 1 equals 2, 1 and 2 equals 3, 2 and 3 equals 5, 3 and 5 equals 8, etc. And as the sequence progresses, the ratio of each number to its immediate predecessor approaches and stabilizes near 1.618 level. Magic, right? And that 1.618 is referred to as the golden ratio. And yes, I will be speaking obviously in detail regarding how to use this golden ratio and also other Fibonacci ratios while trading. But here is a couple of fun and interesting facts about this Fibonacci sequence and this so-called golden ratio. So this golden ratio is present in many things in nature, guys. So the ratio between different body parts, for example, often aligns with that 1.618 level. For example, the length of the forearm to the hand or the distance from the navel to the feet versus the height of your body often approximate this so-called golden ratio. Magic. And many animals out there, such as goats and such as rams, have horns that actually grow in logarithmic spirals following the golden ratio as well. And similarly, the arrangement of some animals' teeth aligns with this golden ratio. And many flowers in the nature also have petal counts that also follow the Fibonacci sequence to actually maximize their sunlight exposure, helping these plants to grow efficiently. Now you guys are asking, what do the goat horns and rose petals have to do with trading, right? Well, nothing, absolutely nothing, to be honest with you. But in trading, the reason why we actually love the Fibonacci ratio, the golden ratio among other popular technical indicators, is because it is popular. And the more popular a technical indicator, the better it works. Simply because the technical indicators that we use are self-fulfilling. So that means that if enough people actually use them as a benchmark and act on them, they end up serving as levels that trigger concrete price actions. This is why Fibonacci retracement is interesting. It is just simply popular. And you can also take the beautiful and round psychological levels like $100 per barrel level for oil, for example. You would also expect offers or support levels to be crowded near these psychological levels, as traders consider that breaching a level that looks interesting would trigger a price reversal or an accelerated price action or anything of that sort. Now, in the context of my market talks, I use Fibonacci levels to identify the key technical levels which could eventually shelter support and resistance levels, and that could eventually trigger trend reversals. So to do that, I use a simple Fibonacci retracement that you can find on your chart. I first identify a bottom and a top on a price chart, and I apply the simple Fibonacci retracement on that proportion of the chart. Now, the length and the proportion of the chart that makes sense to use depends entirely on your time horizon and what type of information you are trying to get. So if you're a day trader, you should obviously use an intraday chart. But if you are looking for medium-term levels, like I do for my Market Talk videos, a resistance level on the summer decline in oil prices, for example, well, you'd better work on a daily price chart, obviously. Now, I'm sure that you are quite familiar with this chart of US crude if you regularly watch my daily Market Talk videos. So once you have your chart and the Fibonacci grill on a chosen proportion of it, well, you get to interpret the numbers that you see on your screen. So there are minor and major Fibonacci levels on a Fibonacci retracement chart. The minor levels are 23.6 and 78.6 levels, and the major levels are 38.2 and 61.8% levels that correspond to the golden ratio and 1 minus the golden ratio. Now, I use these minor Fibonacci retracement levels as a potential support or resistance levels to a price action. And the major Fibonacci levels, on the other hand, are not only expected to give a solid support or a solid resistance to a price action, but breaching them could also hint at a potential trend reversal. So let's take a concrete example. Here's a daily euro-dollar chart, right? The chart shows a swift sell-off in the euro-dollar. So I place a Fibonacci retracement on the sell-off that I see and conclude that in case of a price rebound in the euro-dollar, the minor 23.6% Fibonacci retracement level should act as a certain resistance to the price action and attract top sellers. But pulling out this minor Fibonacci resistance could lead to an extension of the price rebound to the next Fibonacci level, which is the major 38.2% Fibonacci retracement on the same chart. So I would expect to see a solid resistance near this major Fibonacci level, because to me, this level is a major resistance, as I said, to the summer sell-off. And if this level is pulled out, I would eventually consider that the euro-dollar has stepped into the medium-term bullish consolidation zone, and that the price rebound that we see here should extend to the next Fibonacci levels, which are the 50% and the 61.8% Fibonacci retracement levels. Personally, I interpret a significant break above or below the 61.8% Fibonacci retracement level as a confirmation of a fresh positive or a negative trend in the medium run. So if you see me come up with a refresh Fibonacci retracement all of a sudden, well, it is certainly because a 61.8% Fibonacci retracement level has been significantly pulled out. Now, note that this is not rocket science, right? It's just one indicator among many, many other indicators out there that I like to have on my price chart to give a context to the numbers that I see on my screen. Because I also like to have the MACD levels, for example, to have a sense of the daily trend. I like to have the RSI indicator, the relative strength indicator, which is often a very good warning that an asset is probably overbought or oversold in a too short period of time and could call for a correction. I also love to have my 3 moving averages, 50, 100, and 200-day moving averages, to give me a sense of where we are right now in terms of pricing compared to where we were in the previous days. So it's like a roadmap, really. It helps me to, well, situate where the prices are right now, and it gives me an indication about where we may be headed to. But obviously and unfortunately, it doesn't guarantee that prices will be headed where I think they will. That's always the million-dollar question, and that's really up to what you think and how you see the future. So this is all for today's special educative episode. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and informative to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow with a regular market talk episode. Until then, good day trading.